Hello and welcome to this presentation on EAC, Monetary Union Protocol and the Political Federation. This presentation is very much a continuation from explanation and training on the pillars of East African community related to the custom union and the common market. This is a separate presentation of the four pillars that we have and the four pillars that I'm showing you right now, because we want to make a distinction. We want to make a distinction in the sense that the custom union protocol has been implemented since 2005. The common market protocol has been starting to be implemented since 2010. However, the monetary union protocol has been approved and passed by partner states in 2015. However, it's not yet implemented. We do not yet have a a monetary union in the East African community. The political federation is the very last step of the integration process that is envisaged in the Treaty of Establishment of the East African Community. No protocol has been signed there yet, and preparatory work is taking place. Much like preparatory work, although based on a protocol, is taking place with regards to the monetary union. So, without further ado, let's get on with this. All right, I think we all know what a monetary union or a common currency area is. Essentially, is the same money. The same money. That means you do not have shillings. You do not have South Sudanese pounds. You use one type of coins and bills in the whole of East African community. Of course, you don't do this yet. However, the protocol with regards to monetary union of the EAC approved in 2015 says precisely that. The protocol says that by 2024, which isn't really that long from now, the monetary union should be in place. And this presentation is going to be explaining to you some economic background with regards to that, costs and benefits of the having a common currency in one area, such as the East African community, and the progress that has taken place so far in terms of implementation of the monetary union protocol. We then go on and briefly touch on the issue of the political federation. All right. And so, let me start by talking a little bit about the pros, the positives of the monetary union, of having a common currency. And well, the first and most important example is reasonably simple. Why do we have common currencies in regions such as, for example, the European Union that has its euro in 19 or so countries, if I'm not mistaken? That is in order to reduce transaction cost. And so we all know that when we travel abroad, say to Kenya, and we change our money to shillings, we have to pay a commission to change it, and the exchange rate is inclusive on that commission. And so when you have a common currency within a region, you don't have to pay this commission. But what's important is not only you that has to pay this commission, but also many other also businesses. Also financial institutions don't have to pay this commission. All this is reducing the costs of making transactions to everyone, both organizations, institutions, businesses, and the common people. All right? Helps increase price transparency. That is a reasonably simple issue. When you go to Kenya and you say we don't, then you can use your SSP. Okay, sorry, let me not confuse you here. Assuming we have the East African, that could be the possible name of the new currency. Then we have there, and if we're using the East African in South Sudan, and we're using the East African in Kenya, we know exactly how much things cost. That is very important, because it increases certainty and investment, better planning to invest. So what does that mean? That means that businesses, it is critical for businesses to know what things are going to cost in the future. When you make an investment, especially when you make an investment abroad, you want to know, is your investment going to be still profitable in 6 months, in 1 year? And in the situation that your currency suddenly appreciates, becomes more expensive by 10%, your investment abroad, in terms of selling things to another country is losing value by 10% because your currency is more expensive. So if you sell at the same price to another country, that it will be like a 10% increase. And so certainty and investment. And in the situation that you have a common currency, you can also make plans, better plans for the future. When you make better plans for the future, you're more willing to invest. All right? One issue that is quite important, that is this last issue here, discipline against inflation. Reasonably important issue because this is related to something that South Sudan has unfortunately experienced, and that is inflation. And so, in a situation which must happen when you have a common currency, you have one central bank that is guarding price stability, which is inflation, in all of the region, and may be less inclined to support one country to print additional currency to support the budgetary spendings, which often or almost always create inflation. So that is a discipline, because you don't have a central bank that is that it's more difficult to provide pressure by the government to the central bank. So the discipline is better. All right, we talked about the pros, the benefits of the monetary union. Let us talk about the functioning and the problems. Okay, the optimal currency area is something reasonably important. It's a little bit of economic theory, and I will try to explain it in the easiest terms possible. The optimal currency area is an idea that within a monetary union where countries are using just one currency, there is some sort of optimal economic area, optimal in the sense that they need to converge for the economies to behave or to be rather similar in order for this monetary union to work well. Why? Here's the gist of the matter. The gist is that in a situation, if we have very significant disparities in terms of economic growth within a monetary union, and say the far east of the monetary union, a hypothetical far east, is growing very rapidly, and in fact this is putting pressure on prices, then the one central bank would be inclined to possibly decrease interest rates, to increase interest rates to even cool down that economy. And yet at the same time we have the far south of the country that is growing very slowly, and the central bank would want to decrease the interest rates in order to prop up this part of the common monetary union. Now it cannot do this. It cannot do two things at the same time for one region and for the other. And so the economic trajectories of the countries should not be very different. Some other issues related to, okay, and this is the key issue, right? If you have huge differences in economic growth, in economic structures, then this monetary union is perhaps better left for the time until those differences decrease. Optimal currency area also means that it is good to create monetary unions in countries that already have integrated in the past. And so they have implemented the custom union and the common market, and the economy as a whole of the region can adjust in a sense that when we see unemployment in one area, those unemployed can come to another area and therefore smooth the growing of the economy. All right, the same applies to capital, the same applies to trade, and so on. If you have rigid structures in terms of trade, in terms of capital flows, in terms of labor flows, in terms of all the other economic exchanges, then this may not be a good optimal currency area. I've gone a little bit too long on speaking on this. I've already covered this, I've already covered that. And what is very important and what has happened during the Greek crisis is that one way that countries help finance their deficits, governments, and in South Sudan that has been the case back in 2014, 2015, when the oil prices fell, when unfortunately the internal strife has been significant in South Sudan and the budgetary incomes were very low. What the governments can do is support their economies by printing money, essentially. And by doing so, they're devaluing their currencies. And when they devalue, they print money, and they do so in order to finance the deficit. They devalue the currencies, which is associated with printing money also. They devalue the currencies in order for the exports to become cheaper, in order to strengthen the manufacturing and the exporting sectors. And this has been very clearly the case in South Sudan, where in South Sudan the government has devalued its currency very significantly. That has helped to finance expenditures in South Sudanese pound and helped to receive much higher value of oil exports in domestic currency, not in dollars. So, in the monetary union, the governments can no longer do that, and perhaps for the better. Anyways, let me go and talk about the strategy for monetary union in the East African community more specifically. We had covered the introductory issues, and so all right. What is the strategy for monetary union? The key that you need to know is, at the moment, there are preparatory actions and activities taking place. At the moment, of course, there isn't yet the common currency in the EAC. However, those preparatory actions need to take place. The assumption back when the protocol was signed in 2015 was that by 2024, almost 10 years from then, the common currency will be in place. However, there are delays, and the final date for a common currency is yet to be determined. Very importantly, the East African community has what is called variable geometry, meaning that not all the countries need to join all the regional integration initiatives at the same speed and at the same time. And the protocol itself is stating that only 3 out of 5 countries or out of 6 countries need to join in order for the protocol to be operational. So not all the countries need to immediately join the common currency, in the same way the European Union has done. All right. Let us go and talk a little bit about the overview. What does the protocol say? Now, I've been talking about these difficult issues of optimal currency areas and devaluing currencies, and why common economic area is very important in order to create a monetary union. And this is what the Monetary Union Protocol of EAC says, in order to make sure that the East African community becomes this optimal currency area. All right. So what does the Monetary Union Protocol say? Says many things. Harmonize and coordinate their fiscal policies, the East African community needs to do. Not that well done in the European Union. Formulate and implement a single monetary policy and a single exchange rate policy. That is one of the final stages. Develop and integrate financial payment and settlement systems, as I said, in order to create the common optimal currency area. All right, adopt common principles and rules for regulation and prudential supervision of the financial system. Integrate their financial management systems. Harmonize their financial accounting and reporting practices. Adopt common policies and standards on statistics. And finally, adopt the common currency. Okay? Further, what you need in order to become closer to the common optimal currency area, you need what is called macroeconomic convergence criteria. Okay? So in order to implement the monetary union, partner states need to apply a minimum macroeconomic convergence criteria, which are as follows. A ceiling on headline inflation of 8% maximum. A ceiling on fiscal deficit, including grants of 3% of gross domestic product. All right. A ceiling of gross public debt of 50%, reasonably low, of gross domestic product. Okay. And a reserve cover of 5 months of imports. All right. All right. So, more or less finalizing on the monetary union, I just would like to say what is the strategy outlined in the monetary union protocol further. In the final stages before the implementation of the single currency, the newly created East African Central Bank will be formulating a single monetary policy. And so the current central banks of partner states, the Central Bank of South Sudan, of Kenya, of Uganda, will no longer be formulating their monetary policy. And there will be a new institution based, and it will take over this really important role. Prior to that, partner states will be required to eliminate direct central bank funding. This is what I was talking about. Direct central bank funding in terms of printing money of the fiscal deficit. Partner states of CENT will give away the right to implement the policy to the regional entity. East African Central Bank will be allowed to do so. All right. Furthermore, exchange rate will need to be pegged, and the single exchange rate policy will be implemented by the regional bank. So at one point, South Sudan will say that one of the new currency will be equal, say, 500 of South Sudanese pound. And the same will say in Kenya and so on. All right. Few more things. The protocol requires for countries to develop a medium-term convergence program to facilitate attainment of the agreed criteria, taking into account each country's economic circumstances. Perhaps one final thing that I would want to say is in terms of where we are at. In order to implement this complicated work program to implement a monetary union, the East African Community States have decided that even before creating the East African Central Bank, numerous institutions would need to be set up. The first one of those is the East African Monetary Institute, which will be the precursor to the East African Central Bank and will be undertaking research and preparatory work for the monetary union. And it is now already in place. The work, relevant Council of Ministers preparatory work has been done, and the monetary institute is in existence. The East African community will also need to set up a statistical bureau, which will need to track these important macroeconomic indicators. Another East African institution will be the Surveillance, Compliance and Enforcement Commission, because, as we know, example of Greece, that surveillance and compliance and statistics are some of the key issues when we need to talk about the strength of the monetary union and all right. And so, in terms of the progress, we are just 2 years away at the moment, or from 2024, when the monetary union, at least 3 countries should be established. At the moment, there certainly is a delay, and it is difficult at the moment foresee that the monetary union of 3 countries within the EAC will be here in 2 years' time. However, work is moving. The East African Monetary Institute is there, and time will show where the monetary protocol will end up, when it will be implemented. All right. I'm going to be very briefly talking about this issue now. The East African Community Political Federation. The East African Political Federation is an idea that is an African community, and that is the direction the East African community is heading. Having said that, the details are yet unknown. The timelines are unknown, and we will see where the political dynamics of the East African community will take us with regards to the political federation. If you're in the camp of people that are afraid that tomorrow, or in 1 year, 2 years, 3 years, the nation states are going to wither away in East Africa and we'll have some sort of East African country, I will alleviate your fears very significantly. Because the process needs to be accountable to its citizens, first of all, and I suppose it will be, first of all. Second of all, it will be determined by the political dynamics on the ground. So far, little has been done. So far, the East African community focused on the pillars. The East African community focused on setting up a custom union, a common market, and is focusing on setting up a monetary union. The preparatory work has been done. In January 2019, the Summit of EAC Heads of State received a report that all partner states had nominated constitutional experts to work on constitution of the political federation. The summit decided that President Museveni shall provide political guidance to the process. So, the progress here is that draft documents, the background paper for drafting the EAC Confederation, and a comparative study report on confederation jurisdictions has been set up, and are proposing models for political confederation. All right, and public consultations will take place, and the work on this will continue, and we are yet to see where the process is going to take us. I think I would like to conclude at this point. Thank you very much for listening, and I welcome you in the next presentation. Thank you so very much.